How's it going, everybody? Antonio here for some resource talks with Jay Pelosky today. Jay is a professional investor and a former top-ranked Morgan Stanley strategist with over 30 years of experience. And looking at him, he probably started when he was 10 years old. Jay is the creator of the Tripolar World Framework, TPW, which I assume takes the bifurcation of today's world to another level. So he'll be telling us more about that here in a second, I suppose. And then he also created the GRN, which would be the Global Risk Nexus System, which also, I'm hoping it has something to do with time travel because of, or universe travel or something like that. But he'll be telling us more about that here in a second. And yeah, we'll be hearing about all these things. We'll be hearing about, he's going to hopefully also talk to me about why he thinks it's going to be the golden age of asset allocation that is currently underway. Now, neither he nor I will be giving you financial advice today, though. This is going to be just a talk, and specifically one that's general and impersonal in nature. So it's just remember that your financial advisor is not here in the room with us. And this conversation is probably going to contain opinions more than facts, although also facts. So it is your job in the end as an investor to figure out what the facts actually are, double, triple check them, and any information that is provided in here. And it's also your responsibility to wear your big boy panties while taking your own decisions in the end, because the risk of any investment or speculation out there is 100% loss of capital. That all said, Jay, thank you for investing your time in me, sir.
Antonio, great to be here, and already excited for our chat given your intro there. I'm not sure we'll get to time travel, but certainly we'll have some fun, I'm sure.
Yeah, let's hope so. And the pleasure is all mine, sir. Thank you again for being here. You're right. I gave you sort of an introduction there. But there's just so much to say of, 30 years of experience. So why don't you add on to it and tell me who are you and why do you think you're worth listening to?
Uh, well, sure. I guess I'm worth listening to. I mean, probably in my house with my wife and two teenage boys, I get some pushback on that. But I guess I do have, quite a bit of experience. Started out actually in the late 80s, believe it or not. I'm doing non-Japan Asian emerging markets. Joined Morgan Stanley in 1990. The first thing I was asked to do was to start a Brazil fund, which was right in the era of hyperinflation and taught me a great lesson about investing, namely the difference between the time to market and the time to invest, right? So Morgan Stanley and the IFC, which was and is an arm of the World Bank, were trying to raise, money to start this Brazil fund. Couldn't raise any money, no interest whatsoever, and did get the fund raised because Barton Biggs, who was my boss at the time, famous Morgan Stanley strategist, his friend Julian Robertson, famous founder of Tiger, was willing to put in some money to get the fund off the ground. So not the time to market, but if you go back and look, 1990, 1991, the absolute dollar low for the Brazilian equity market. So it was indeed the time to invest. So great lessons learned there. Then served time as the Latin American equity strategist for Morgan Stanley. That sticks in my mind because I was out hiking in California, Northern California. You're camping and you hear noise outside your tent at night. And you're like, oh, what's that, right? And you get a little scared. So I wrote a piece. I came back and wrote a piece about bears in the woods and don't worry about a Mexican devaluation. So, a week later, in the middle of the night, Mexico devalues, right? The famous peso crisis of 1994. And I was front page of the Wall Street Journal. I was ranked #1 in Latin American equity strategy by Institutional Investor at the time. So, page one example of how Wall Street got it wrong. And another very, very good point at that time was I was pulled aside by Byron Wien, another one of the famous Morgan Stanley strategists. We had a totally stacked macro team at that time. Byron is now vice chairman at Blackstone, pulled me aside and said, "You can be wrong at the top and you can be wrong at the bottom, but you can't be wrong at both." So, I was clearly wrong at the top. So his point was that I better make sure I nail the bottom, right? And really get clients engaged at the right point. Then did global emerging markets strategy for Morgan Stanley, and there is when I start the clock on global multi-asset work, because our global emerging market strategy product, or GEMS, was the first ever multi-regional, multi-asset research product at Morgan Stanley. And so that was just in time for the Asian financial crisis in 97, 98, the Russia too big to fail crisis, too nuclear to fail crisis. So I've been marketing or research or working in over 50 countries around the world. I guess that global emerging market strategy product was 95. So coming up on 30 years of consistent global multi-asset investing, recommending, research, etc. My last job at Morgan Stanley was head of global asset allocation. Did that for a number of years, and then left the firm, left the business to start a family in the early 2000s. And so for the last 20 years, I've been investing my own capital along the lines of the asset allocation processes we developed at Morgan Stanley, primarily using ETFs. I think ETFs are absolutely fabulous for people trying to do a global multi-asset model. You can pick 20 ETFs and have a well-diversified global multi-asset model in a way that would have been absolutely impossible even 15 years ago, given how much research capacity you would have to be able to identify companies of that nature to fill out that kind of a portfolio. So over the last 10 years, bringing up to the present here, I've been running basically my own investment advisory boutique under different kind of guises, different names, etc. Currently, for the last 3 years now, we've been TPW Advisory. You mentioned the tripolar world. Hopefully we'll get into that. It's a thesis I developed over a decade ago. But TPW Advisory offers independent portfolio strategy and asset allocation advice to both retail and institutional clients, both here in the US. We're in New York City, where I have been for almost 40 years. Here in the US and internationally. We also offer two model portfolios. One is a global multi-asset model. My own capital is invested alongside that. So differentiating me again, why you may want to listen to me, is because what I say is how I invest. And there's no distinction between the two. And then we have a TPW 20 100% thematic model, taking 20 ETFs and focus purely on thematics such as future tech, climate, demographics, et cetera, et cetera. So long-winded. Last thing I'll say, I guess, is I write every Friday, Friday Musings, and then we do a big monthly deep dive, which we just did last Friday, The Birth of the New. 5,800 words, 23 charts and tables from 20 distinct research sources that I curate myself out of hundreds and hundreds of charts that we look at on a monthly basis. So that's TPW Advisory. That's Jay Pelosky, and ready for our discussion.
I like it. I like the overview here, and you're right. I'll put a link in the show notes for people listening or watching this to the Birth of the New, the post that you wrote. Indeed, 5,800 words, as you mentioned. You calling it the birth of the new, and I also saw you recently retweeted something from your ex-employer Morgan Stanley that basically said that their baseline for 2023 still remains soft landing. with no recession and a rate cut in early 2024. So no more rate hikes and a rate cut in 2024. And what's interesting in this and in the piece that you wrote on your website, I think you also did a short overview on YouTube. Yeah, it was like a short 25-minute video, something that you did. I might link that as well. Is that what's interesting here to me is that most people I've talked to or interviewed here on this channel specifically would disagree with the soft landing narrative, and most of them expect at least some kind of an economic slowdown. So how do you see a soft landing materializing? Like, what indicators are telling you that it will or that it might?
Yeah, no, it's a great question. And I posted that Morgan Stanley thing because that was their economics team. And, at the same time, same day, there's a Bloomberg story about their cross asset team saying that there's going to be a 15% fall in earnings and stock market decline. So it's kind of that the challenge of putting a big house view together. Again, I was, I ran Morgan Stanley's asset allocation strategy process. So I know very well the challenge of getting all the different pieces, to kind of quote unquote agree on a house view. And that's another reason why folks should listen to at least some independent people, because they don't have that challenge of having to, shoehorn their view or trim their perspective to fit the house view. And the house view has real value because, there's a lot of intelligence around the table and you can glean from that for sure. But the independent view, I think, also has a lot of value, particularly in today's world where, let's face it, we've been in an ahistorical period for a number of years, right? Really since COVID. Or you could argue even going back to the great financial crisis after '09, that was the biggest crisis, the biggest market crash since the 20s. COVID, the biggest global pandemic since 1918 in the Spanish influenza flu. So I believe we're in an ahistorical period, and therefore you have to be able to think differently and be open to thinking differently about how things play out, because history, particularly recent history, I don't think is going to be all that useful. And it hasn't really been all that useful. You go back, many people who are, bearish and expect a recession, et cetera. And that is by far the majority of people, right? The consensus has been and continues to be, stocks are going to be weak, cash is where you want to be, economy's going into recession, earnings are going to fall, et cetera, et cetera. And what's amazing to me is that ACWI, right, global equities, are up almost 12% year to date. And we're not even 6 months through the year. So if you annualize that, you're talking about a global equity return of well over 20%, whereas cash has yielded so far about 1.5% US dollar cash. Japanese cash, for example, is down 5%. If you're wondering why Japanese equity is doing reasonably well. So I don't really get this idea that, we're just going to continue to dismiss the reality of markets up 12% and cash yielding 1.5%. If you have any cash in your, benchmark to ACWI or whatever your benchmark is, our global multi-asset model is benchmarked 50% ACWI, 40% Barclays Ag, so global fixed income, 10% Goldman Sachs commodity index. And that's our benchmark, right? So one of the things you want to always understand whenever you listen to people is what are they targeting? Because what they target will influence what they want to talk about and how they think about things. So we're global multi-asset in our flagship global multi-asset model. And our thesis has been, Antonio, for a year now, right, that we're going to be in a soft landing, or what we call the middle path, right? If you go back to look at our website under our musings and see all those pieces that I've written over the last year, you'll see references to the middle path between high inflation and deep recession. And our feeling is that we are in a high nominal growth world, right? Where in the 2010 to 2020 period, pre-COVID, it was low nominal growth, very low inflation, very low growth, right? So nominal growth in the US was like 4%. Nominal growth in Europe was like 2 to 3%. Yeah. Nominal growth in Japan was basically zero because they had deflation. And now we're talking about over the last year, as an example, over the last year, nominal growth in the US has been running close to double digits. Close to double digits. Similar in Europe, about 8%. Now, granted, nominal is real plus inflation. So a lot of that is inflation. But you have to remember that earnings and sales are in nominal currency, nominal dollars, nominal euros. And that's what drives markets is earnings, equity markets anyway, right? So the idea that you're going to have big earnings shortfalls when nominal growth is almost double digits just doesn't make any sense. And that's an example of people using the prior mindset model of the low nominal growth world and making a mistake in saying it's going to be extrapolated when the data was showing you that we're in a high nominal growth world. So our feeling is that going forward, we're at the end of the Fed rate hiking cycle. The Fed is done. They're not going to raise in June. They're not going to raise in July. The May inflation number and June inflation number in the US is going to look very, very good because May and June of last year, inflation was roughly 1%. And we're going to be replacing those 1% numbers dropping out is going to be replaced by inflation of 0.3% or 0.4%. So we think by the June inflation report, which will be in July, which will be before the July Fed meeting, okay, that US inflation is going to be running sub 4%. Sub 4% by the June report, which is July. So the Fed is going to be done. No need to raise rates when inflation is running at 4% and you have already a Fed funds rate over 5%. So you have a real Fed funds rate that's over 1%. You will also have at the same time an economy that we believe is moving out of the slowdown that took place in 2022, right? And think about the main factors for that slowdown. There were three. There was a housing crash. There was a massive inventory destocking, and there was a tech-generated layoff cycle. And our argument is that all three of those are ending, right? Housing is clearly bottomed in the U.S. Doesn't matter what you look at. Houses sold, new homes sold, prices of new homes, home builder sentiment. Again, people are just taking the mortgage rate at 7% and saying, okay, that's got to lead to a housing crash. So you have this amazing juxtaposition where you have the media talking about housing crash, housing crash, housing crash. And then you have XHB, which is the home builder ETF, hitting new highs, literally hitting new highs. I mean, it's up 20% off its low. Its low was last November. So the market is a forward-looking discounting mechanism, and it is telling you what's going to happen. And I believe that Mr. Market, or Mr., Ms., Mrs. Market, whatever, the market is inherently smarter than anyone independently. So I like to let the market tell me rather than me tell the market what's going to happen. So housing is bottomed. And the fact that mortgage rates are 7%, all that means is that everybody who bought homes over the last 2 years at 3% mortgages are not going to sell, which means that the only homes available for sale are new homes, which means that home builders are doing great. So that's the process. And yet, you can pick up any paper and read about a housing crash. It's just completely wrong. Completely wrong. So then the second is the inventory destocking. We believe we're approaching an inventory restocking process. right? And that is going to take the manufacturing PMIs that are sub 50 in the US and in Europe and take them back above 50. And this is another reason where people are like, oh, recession, recession, recession. And my response, and you talked about facts, my response is the S&P global composite, so global composite, meaning services and manufacturing, hit a 16-month high in May. 16-month high in May. That's not recession. That's the opposite of recession. So, and we believe the tech layoffs are over, right? AI, tech is going back in a different direction. And so when we put those things together, we believe we're in an early cycle global economic recovery begun in Asia with China coming out of zero COVID. China is going to grow 5 to 6% this year. Second biggest economy in the world, growing at 5 or 6%. How do you get a recession out of that? And then you have Japan. Japan is exiting deflation. Japan is growing faster than the United States, faster than Europe, and just hit a 13-year high in its own PMI for May. So when you think globally, and that's one of the strengths of TPW Advisory, I'm a global multi-asset macro guy, and I have been for almost 30 years. And we have a framework that allows us to think constantly and coherently about the world, not just one little bit or piece of it. And that, of course, is our tripolar world framework, which we can get in either next or at some point, but I'll stop there.
A lot of things to touch upon, indeed. PMI, housing, all these things are interesting to touch upon. It's also interesting that the manufacturing PMI, it seems like it's a K-shaped recovery, right? Manufacturing going down and services PMI going up again. So, but I want to touch upon that later on, because I have one question about the Fed bringing inflation down, which is how. Because if you think that you know we're going towards great times and we're going to have growth in consumption, so growth in demand, isn't that going to reflate the economy? Wouldn't that mean that the Fed is going to have to tighten? So how is the Fed going to bring inflation down unless they keep tightening either the financial economy or the real economy?
Yeah, no, excellent question. And part of it is, as I said, we're just replacing, it's numerical, it's math, right? You're taking 1% and dropping it down to 0.3. So, you know, your year-over-year number obviously comes down dramatically, just like it went up dramatically because you're replacing 0.1% with 1%. So it's a spike, and it's a COVID-related spike, and we're coming off it, and we're going into disinflation. Now, where I think the question, the rubber meets the road, is the Fed going to tighten, or does the Fed need to see a two-handle on inflation, right? Because if it needs to see a two-handle, you're probably not going to get there simply through the disinflationary process, particularly if we're right about the economy starting to pick up as we go through 2023 second half and go into 2024. So that's where I think the key issue is. And that sets up one of the things that we think is new, the birth of the new. One of the key things is that we believe central banks in the West, in the US and in Europe, because let's remember, there is no inflation in China. China's inflation is running at 1%. China actually has arguably an excess capacity issue and a lack of demand issue. And in Japan, yes, they have 3% inflation, but they're desperate for inflation. And we can, again, touch on that at some point, because Japan is a market we like a lot. We're very overweight Japanese equity. But to get back to the point, we think the Fed and the ECB are going to, if not overtly, come out and say we're changing our inflation target. They're implicitly going to accept a slightly higher rate of inflation, namely 3%. And one of the things we link to and show in our monthly is some work by McKinsey, which has gone through this same process. And basically the argument, Antonio, is that To get to 2%, you have to crush the economy. And it's in today's day and age, it's not worth crushing the economy and throwing millions of people out of work to get inflation from 3 to 2. And instead of that, the Fed is going to basically declare victory at 3%. And you're going to have a world where you have 3% inflation, 1% real interest. And so you have a interest rate structure of around 4%. That's where we are today. And that's one of the reasons why we have never agreed and never accepted the idea that there were going to be significant rate cuts in the second half of this year, which up until 2 or 3 weeks ago was what was priced into the fixed income market in the US. Now that's been priced out. That to us is the fixed income investor saying that we're not going to have a recession, right? Arguably, a recession has been priced out of the fixed income market over the last several weeks. And the equity market is starting to price in the same thing. Equities have not been priced for a recession, but they've been positioned for recession, right? Everyone overweight defensives, everyone in cash, and now that's starting to shift. And again, you can see it, the market is telling you when you start to look at some of the cyclical sectors in the equity market, starting to finally catch a little bit of a bid. But our view, in essence, is that 3% is the new 2. And just for your audience, understand that the 2% inflation target was a completely arbitrary target. There's nothing intellectually sound or validated about it. It was a number that people could agree upon, and it's only been the quote-unquote target for less than 15 years in the United States. So don't look at this as some sacrosanct, all-important number. It is a number that can be moved, and we believe will be moved, in order to sustain an economic recovery. And oh, by the way, everyone's worried about government debt. Well, how do you take care of government debt? You eat away at it a little bit. You debase it with a slightly higher inflation number, and that's what I think we're going to do. And that's one of the key factors in the birth of the new. It's actually the first one that we talk about in our piece, is this shift from 2% to 3%, or what we call a high nominal growth world.
Okay, I see your I hear your arguments, better said, and I've tried playing the devil's advocate with some of those to some of the most bearish people that I've had over for a chat, and one of them told me something interesting, kind of funny, that sort of stuck with me. He said that if you take a random walk down Wall Street and you pick somebody, a random money manager, and you throw them off the top of a building, although he didn't advocate for actually doing that. But he said that halfway down the building, they'd look back up to the top and say, hey, so far, so good. And he was making the point that that's because most money managers are looking at lagging indicators, and most of them realize that we are in a recession after we've been in one for like 2 quarters, because that's, I guess, the official definition of a recession. So here's what I'm wondering with that is, like, okay, you're saying the Fed doesn't necessarily have to crash the economy because they don't have to get the inflation to 2%, being at sub 4%, is already sufficient. But they already did quite a lot, right? They raised 500 basis points in a little over a year. So considering what I previously said, and that most indicators are lagging, surely it's going to take time for the effect of that rate hike that we've been experiencing over the last, 15 months to show up in some of those indicators that you're mentioning.
Yeah, I actually think differently about that. I mean, we've been very focused on speed. And, again, go back and look at our writings, you'll see speed in the title, going back all the way to COVID and what we call COVID speed. We wrote about climate speed. We wrote about analytical speed. And the most recent version was narrative speed, which we published in January of this year. And so we think things are sped up. And again, we talk about it, the first line and the executive summary of the birth of the new is that the past few years have felt very sped up, and they have felt very sped up. And so I think that our feeling is that looking backward is not has not really ever been particularly valuable. It's been valuable in ensuring that people keep their jobs, right? People in this business, because it's much easier to say what has happened than to, take risk and peer into the near future and talk about what is likely to happen. We're very much in the the latter camp. We are believers in that it's worth taking the risk to look into the near future. And we think the age of AI, as is coming down the pike, is only reinforcing that conviction, because the province of looking back is going to be a machine's job very, very soon, if not, for the most part already. So I think that's going to be a great thing, because many, many people in this business make a good living just talking about what has happened, as opposed to working on what's going to happen. And so one of the things that we focus intently on is, what's going to happen. And look, the idea that the Fed tightened aggressively and we haven't felt it yet is just completely misplaced. We had a housing crash, people. Now, where does the Fed typical cycle of raising rates, where does it have impact? It has impact in housing, because that's the most sensitive to the rate structure and is felt immediately. As soon as the rate goes up in Fed funds, your mortgage rate goes up, or the mortgage rate goes up, right? And so it's already happened, is my point. And then secondarily to that is the second big factor in the birth of the new, okay, which is the new industrial policy taking place in the United States. And this is, again, why people are not understanding what's happening, is because we haven't had an industrial policy in the US in 60, 70 years, since the 50s, and when we built out the interstate highway system. We haven't had anything like what's happening now, which is hundreds and hundreds of billions of dollars being spent to develop the new industrial strategy of the United States. And this is a key difference. And in one of the reasons where it's felt and manifested is in the absolute surge in non-residential construction spending. And that helps understand why, even though housing had a crash, there wasn't a big layoff in the construction sector, which is, again, where you typically start to see that action from the Fed, that reaction to the Fed rate rise. It's because today, and again, we have charts in the monthly that show this, non-residential construction, manufacturing construction, factory construction is off the charts. It's up over 100% and is going to continue to be up over 100% year over year, because there's going to be trillions of dollars spent in the United States over the coming, between now and 2030, to recast supply chains, to ensure that we have an electric vehicle supply chain construct in the Americas, to ensure that we have the ability to produce as many semiconductor chips as we want and need to power AI, to ensure that we are leaders in AI. Semiconductors are the pick and shovel of AI. If you want to know how to play AI, buy semis. It's that simple. It's just like the gold rush, right? You didn't get rich in the gold rush by panning and getting nuggets out in California. You got rich selling them the blue jeans, Levi Strauss. It's a quintessential example. So, the things that are taking place in the new industrial policy is an absolute game changer in the amounts of money. This is one of the reasons why we're constructive. And as we wrote, we think the birth of the new is going to drive global cross-asset market pricing and performance from now through 2030, is because so much of this is climate-centric, and now kind of security and tech centric, which are all focused around the next decade to meet all the goals that have been expressed out there. And this is something that in the US and in Europe to a large extent, right? Fit for 55, Green Deal, industrial policy. Europe's having to respond in the same way. And so these are massive ahistorical changes that if you're simply looking at the past and saying, okay, Fed raised rates 500 basis points and we got to have a recession. Okay, it's just is simplistic and lazy and incorrect. And then one other point that I'll just add in here is, and again, we showed the charts in the monthly, is the growth of the private credit market, right? Because it used to be that if the bank wouldn't give you a loan, you had nowhere to turn. Well, today, guess what? You have a $500 billion private credit market that has grown up in the United States over the last decade, since the great financial crisis. And guess what? 350 billion of that 500 billion is dry powder.
I'm thinking a lot about housing, and by the way, you made a point on Levi's jeans. Actually, the best way to play that was they recently found a pair of Levi's jeans. I don't know if you saw that in a mine in Mexico or something from the 1880s, and they sold for like $100,000. So that was the best way, buy them and hold them for like 150 years. Now, what I'm thinking mostly about is the pressure on the consumer, though, because personal income is not growing as quickly as personal spending. Personal spending is actually growing twice as fast as personal income, or has been recently. And I'm thinking about the effect of housing on all of that, because, the leading indicators for housing are mortgage rates, again, 20-year high. But more importantly, also, I guess the velocity, you said you're not too concerned about that, but the velocity, which we've gone from all-time lows to now 20-year highs in housing, is interesting to me. But again, you mentioned housing inventory is very low, housing supply is very low. So it doesn't seem like the price is going to come down. The prices are high, and they have come down a little bit, actually, in May. But refinancing activity has gone off a cliff in May. So it's not like, okay, housing has gone up, so let's refinance and spend away. So people are not doing that. So I don't know. The housing starts also reflect quite nicely all that I told you, with them also being on the lower end. So how's that not putting pressure on the consumer when housing is as high as it is?
Well, I mean, first, as you pointed out, housing prices have not come down materially. Most people still have made money if they bought over the last couple of years. And one of the differences, Antonio, that you really need to understand is that, pre-great financial crisis, a lot of mortgages were floating rate, right? Adjustable. Mm-hmm. And people got hammered on that. And so post-great financial crisis, very few mortgages were offered on an adjustable rate basis. They were offered on a fixed rate basis. Thus, the consumer is not feeling, the homeowner is not feeling that strain of, their 3% mortgage doubling to 6 or 7%. It's not happening. That's not the way mortgages work in the United States anymore. So anybody who bought over the last 5 years, the vast majority of them have fixed rate mortgages. So they're not affected at all, which is why they don't want to sell, right? Because when you sell, yes, you sell the house, that mortgage goes away, you buy the new house, and that new house is going to be at a 300 basis point difference in your mortgage than what you were paying, which is why, again, no one is selling the houses, which means that the only inventory is new build, which means that the home builders are making money. And that, again, as an investor who owns the home builders, that's what I care about. I care about that, Toll Brothers and Pulte and Lennar are making money. And they are. They're making lots of money. And therefore, the stocks are going to continue to do well. As far as the consumer is concerned, what I look at is much more the kind of the pressure on expenses, right? Like debt expense, interest expense, things of that nature relative to household income. And those numbers are not at all threatening, right? You pull up any chart that looks at, debt financing as a percentage of household disposable income. Absolutely not even anywhere close to any problem level. So I don't really see that as an issue. What I see is a labor market that's basically at full employment, that has the highest labor participation rate in years. So more and more people are working. And when people are working, they're getting money, they're making money, and therefore they're able to consume. Now, again, I grant that, and there are people I respect, who take the other side of this and are quite worried about the consumer. I don't really see that absent, a significant surge in layoffs that will kind of hit the economy in a kind of sudden fashion. And that, as I said, we don't expect that, given that we think the Fed is finished, that the destocking is about to go to restocking, and that housing, as I said, is already bottomed. So I don't necessarily think that the consumer is going to, take us into 4, 5, 6% growth. I'm thinking that the U.S. is going to grow, in that 3% type level for the next couple of years, which, call it 3 plus 3% inflation, gives you the nominal growth of 6, which is again double the nominal growth we had 2010 to 2020, which means to me earnings are going to be fine, which means that, the stock market is probably going to be fine in the US. I mean, to be clear, and we haven't really touched on it yet, so now's maybe a good time, we are overweight non-US equity and underweight US equity. So we see better opportunities outside the United States. So if you're thinking about outside the United States, then what the best course of the best kind of environment for that is for the US equity market to kind of just be okay, right? Because when the US market falls, everything falls, we know that. And when the US market soars, nobody cares about anything else. We know that too. So if you're making an argument, as we are, that we're entering a period where non-US equity is going to have equity leadership, which has been not the case since the low in 09, right? Since the low in 09 till about the middle of last year, US equities massively outperformed. And over the last year, non-US equities have outperformed, led by Europe. And we're making the case that we're in the early innings of that leadership rotation. It's one of the two main rotations that we're looking at, right? One is from US equity to non-US equity leadership, and the other is within US equity from big tech to cyclicals, based on our view that the economy is going to start to recover. So just to be clear, when we talk about the US and the US market, we're not uber bullish on US equities. We like the rest of the world more. We think US equities are going to be fine, but other places are cheaper. Other places are completely underowned. Other places are growing faster, et cetera, et cetera.
It's interesting you should mention it specifically today because last week Germany basically started a recession, right? Because they published the second quarter of negative GDP growth. And today there was also some data coming out of Europe. So the Eurozone's investor confidence and business activity declined quite a lot. And the UK's private sector declined as well. So it's not, to me as a European, it's also not looking very bullish here in Europe. So it's interesting you should say that, especially with the manufacturing sector here declining. So how do you see it? I mean, where do you see growth coming from? You can also talk to me about the US as well. Like, what part of the economy in the US or in Europe do you think is going to cause that GDP growth of what you said, around 3%?
Yeah, let's just finish up with the US because we've already talked about that a lot. Sure. So again, quite simple. Housing is bottomed, record low unemployment, a restocking cycle in the manufacturing space, and the productivity that's going to come from AI sets us up for what we believe is going to be a period similar to the second half of the 1990s, which was the last time you had a productivity-driven CapEx boom in the United States. And we expect the same globally this time. So it's not just US-centric. We expect a global CapEx boom augmented by AI-driven productivity to generate above trend versus the last 10 years, global growth. And we see that manifesting, around the world to deal with what we call the 3 Cs of COVID, climate, and conflict. And it's really being centered around these tripolar regions of Asia, Europe, and the Americas, where, as we touched on earlier, everyone wants to have their own EV supply chain. Everyone wants to have their own semi-fab production capacity. So you're seeing it happen in Europe. It's no different than in the United States. TSMC and others are setting up plants in Europe because they want to spread out their manufacturing base. They're setting up plants in the United States. The Chinese battery companies are setting up plants in Europe. They're doing the same thing in the US and in Canada, and in less so in Mexico, but support activity in Mexico. So that's the Americas region. The European region is integrating to deal with the conflict with Russia's invasion of the Ukraine, dealing on energy security, dealing with defense security. All these things are driving Europe closer together. We see Europe as potentially one of the big winners, the big winner of the 2020s, which is very, very counter consensus, and have been writing and talking about that for several years now. Everything I see that's happening in the climate side, on the EV side, on the semi side, is driving regional integration and regional deepening. And the same is happening in Asia, where you have not just China growing, you have Japan coming out of deflation for the first time in 30 years, you have India growing, and you have much of the manufacturing that's meant for export shifting out of China. So what you're doing is you're seeding all of Asia with that production capacity. And it wasn't only a couple of years ago where people were worried that middle income countries were going to miss out on the manufacturing leg up because it was going to be concentrated in China. Now, 3 years later, Vietnam, Malaysia, Indonesia, Thailand are all beneficiaries of the China +1 or +2 production platform basis. And so we are big believers that the path forward for the globe is regional integration. And we have been talking and writing about it since 2010. And everything that we see, and again, you can look in our work and on our website, you can see the various descriptions of tripolar world in there. And so we see climate, we see conflict, we see things of this nature as driving regional integration. And so for Europe, again, to kind of get back to the question of what's going to drive European growth, record low unemployment. Start off with that. More people working than ever before in the history of the European Union. We have inflation coming down faster than expected. No surprise, as many, you quoted all the negative points about what was that data points from Europe. I'm the optimist, so I'll give you the positive one, which is that inflation is falling faster than expected. I'll take that and double it by talking about the European service PMIs, which remain very robust. Talk about the composite PMI, which makes up the two, still well above 50. And remind everybody that, in the US and in Europe, services make up 65 to 70% of the economy. Manufacturing gets a ton of headlines, but it's only, in the US, it's like 12% of the economy. In Europe, it's probably slightly more, but I imagine less than 20% of GDP comes from manufacturing. So the focus in Europe on, again, the money that's going to be spent and is being spent in Germany, right? Germany needs to get its act together across the board. Infrastructure, the switch from ICE vehicles to EV vehicles. Germany has an awful lot of work to do. The spending on climate, the spending on energy is going to benefit the periphery. That's why you see Italy growing faster than Germany, right? Yeah, so Germany just did go into a technical recession, extremely mild, but a technical recession nonetheless. What did the DAX do on the day that news came out? Virtually nothing, down 0.3%. What has the DAX done over the last year? Up massively. Europe's up 30%, 35%, European equities over the last year. So all that period of time where people were super worried about energy crisis and Europe freezing in their homes over the winter and a disaster in the economy, completely wrong. Completely. 100% wrong. European stocks have been the best performing stocks in the world over the last 12 months. Thankfully, we can say here, we have been overweight Europe that entire period.
So it's like you're overweight a lot of stuff, and I want to talk about those.
Yes,
but I also want to talk about
underweight the U.S.
Okay. I also want to talk about the labor report from May, though, because you said you're talking about unemployment at the lowest levels in the U.S. What's happening now, though, is that unemployment spiked up to 3.7% in May. And the headlines were good because there was more jobs added, almost twice as many jobs added as expected. What I'm noticing in there, though, and that sort of worries me, and you tell me why I shouldn't worry about that or why I should, is unemployment spiked up. Labor participation largely stayed flat. Wage growth is not keeping up with inflation unless that starts coming down more aggressively. You average out over the year, although we're not supposed to do that you come out at around 3.6% wage growth annually, not enough to combat inflation. The hours worked dropped, average hours worked dropped. People are hoarding their jobs, so less people are leaving their jobs. So in the lowest number in what, 2 years or something like that. And there seems to be cracks showing in self-employment. So that's where the unemployment rate spiked up from, because self-employed people are sort of losing their jobs, I guess. And manufacturing, again, also showing cracks with 2,000 jobs less in May. So those are the things that I saw in that May jobs report that worried me. Why are you not worried about that?
Yeah, no, fair points. Because look, I think a slowing or a cooling job market is fine, right? That's great. A collapsing jobs market is not great. So I guess I'd take exception to the term spike when you go from 3.4% to 3.7. I think that's far from a spike. A spike is 3 to 6, something like that could really get people unnerved. We're just dancing around the lowest unemployment levels that we've had, again, in history in the United States. And again, same in Europe, again, same in Japan. The only place where there's an employment issue, arguably, is in the young people in China. But amongst the major economies, having the most employed workforce of history is unambiguously a positive for consumption, for growth, and arguably for stock prices. And so, I as I say, cooling job market is fine. That's absolutely, we need that so that we can bring that inflation level, down to the 4%, sub 4, as I said, by the June report. And then, meandering around 3 to 4% and going down further towards 3 as the rental component, which we haven't really touched on, but rent is a big factor in the service side of the CPI, and that is going to come down significantly in the second half. And again, we know that just from what rents have done, there's just a period of time before it gets into the CPI calculation as a whole. So I'm kind of on board with your view of the labor market in the U.S. Cooling is fine, collapsing is not. I don't think we're going to have a collapse. Okay.
Fair points. I think the market also, as you said, largely agrees with you. I mean, if I open the CNN Fear and Greed Index over here, sitting at 74. So what I'm seeing is quite a lot of people are being bullish. The S&P 500 momentum way above the 125-day moving average. What else? Put to call option ratio 0.75, very, very, very low. Specifically for the last 52 weeks, of course. VIX also really low. But so what about, be greedy when others are fearful and fearful when others are greedy?
Yeah, no, I think we're, I'm not sure that the fear and greed index you mentioned, what kind of utility it has. What we look at is cash and allocations to cash and things like the Bank of America Fund Manager Survey, which just came out, I think, 10 weeks in a row of heavy inflows to cash. You look at the money market funds closing in on $6 trillion of cash. People are very, very defensively positioned and or very heavily overweight cash. And as I said earlier, that almost guarantees underperformance with ACWI up 10% in the first half, 10 or 12% in the first half of the year. So I think people are positioned very defensively. If you look at the allocations to defensive sectors, that would support that thesis as well. So I don't really buy the argument that people are, wildly bullish or constructively bullish. I'd say most people are underperforming, overinvested in cash, waiting for the fall, the recession, which will lead to the fall in earnings and justify the recession and bear market call that the vast majority of Wall Street still has. If you look at targets, for example, year-end levels for the S&P, most people are still well below where they are today. And so, the way we look at it, though, is that we're on the cusp of what I mentioned earlier, which I think is really important in terms of thinking about positioning, is on the cusp of a major rotation, right? We talked about the rotation from U.S. equity leadership to the rest of the world, right? We think we're in the first or second inning of that after 10 plus years of U.S. equity outperformance. So everyone in the world is overweight U.S. equities, and that is now going to start to feed the rest of the world as that money reallocates. Similarly, in the U.S., folks are massively overweight cash, and that cash is going to be the fuel to take the market higher and to, in our view, sustain the rotation. So right now, what we've had a market that's been led by big tech, driven by the AI enthusiasm, which makes perfect sense, right? If you think about it, tech was down 25 or 30% last year, had a serious bear market last year, big tech, right? Big tech is exposed to higher interest rates. That's what led to the bear market. Well, guess what? In our view, at least, there's no more higher interest rates. So that issue is off the table. AI has come along. It has a huge moat around it, given how expensive it is to run large language model type work. So that is the province of big tech, not going to be eaten away by some startup type company that creates a new AI in its garage. So all that justifies the big tech move in our view. And as we talked about, we're playing it primarily through the semiconductor space. Now, what hasn't worked is any of the cyclical stuff, which of course outperformed last year, right? So energy, financials, home builders, industrials, transports, those five have not really done much at all this year. We think we're on the cusp of that rotation to that side of the market. And we're heavily invested within our U.S. equity allocation. We have a barbell. So U.S. tech through semis, cyclical sectors, the five I just noted. That's our barbell within our U.S. equity allocation. And so the way we see things playing out is that the Fed in less than 2 weeks on the 14th is going to pause, no rate hike, And as we said, we believe that's going to actually signal the end of the rate hikes. And then B, more importantly, they're going to raise their GDP estimates for 2023 and 2024. June is the period where they adjust their economic forecasts. We expect to see a higher 2023 GDP estimate and a higher 2024 GDP estimate. And we think that is going to put the final nail in the coffin of the recession call. That in turn is going to take us from the 4,200 range, which we've finally broken through. Again, in these types of markets, we like to look at technical analysis. We're not technicians, but we're equal tool in the toolbox kind of people. Whatever works, we want to be using it. And in ahistorical markets, technical analysis is really valuable and has been very valuable for us over the last couple of years. So S&P just broke 4,200. The Fed doing what we just said they're likely to do is going to take us over 4,300. 4,300 is important because it will mark a bull market from the bottom in October. And that is going to force people to come in and take the market higher. And so what you want to be doing now is not buying the big tech, but you want to be buying the cyclical stuff. And lo and behold, it's starting to work. As an example, we talked about XHB, home builders, right? Doing very, very well. Look at the chart. Transports, we noted IYT just broke above its 200-day resistance level. Transports, okay? That's telling you the market is setting up for a better economy, not a worse economy. Breaking down below 200-day support is when you see breakdowns. Breaking above is when the market is positioning for better things to come down the road. So in our view, that's what's likely to happen. That's how at least we're positioned, is for the Fed to not only go on hold, but to validate the soft landing, eliminate the risk of recession, and force all that money on the sidelines to get back into the market.
You say that in 5.5 years ago, by the way, you went on Bloomberg too, and you said that U.S. assets were over-owned, and with the NASDAQ now twice as high, makes sense. So you agree that they are over-owned. Commodity stocks, commodities, they're definitely under-owned. Gold, historically under-invested, both, actual investment as in exploration, mine building, and stuff like that, specifically when it comes down to copper in that case, but also just as in people's portfolios, commodities are heavily underweight. What is your approach to that? What does that mean? That you like commodities going forward, or how do you look at it?
Yes. As I mentioned earlier, in our global multi-asset model, we have a 10% benchmark weighting to Goldman Sachs commodity index, right? Which
That's mostly oil, though, right? The Goldman Sachs commodity index.
We know is about 60% oil, but it's one that we were easily able to track, and that's really the point of why we chose it. But and more importantly, again, for your audience, is to understand that we pay attention to commodities because it's in our benchmark. And so we want to, know what it's doing. We want to have positions there. We want to be overweight, underweight, et cetera, et cetera. So going back to the very high level asset allocation, we have been and remain overweight equities, underweight U.S., overweight rest of the world, underweight bonds, deeply underweight bonds. I mentioned our benchmark is 40% fixed income. We have about 12% in fixed income. Virtually nothing in the sovereign space, almost all in the credit space, U.S. and EM high yield, and EM local currency debt. And then commodities at 10% of our benchmark, we have close to a double weight in commodities, okay? And so that has been a big drag on our performance because, as you pointed out, it hasn't worked, right? Oil's down, copper's down, most base metals are down, ag, we don't really participate in. Precious metals have done okay. We're in the gold miners, GDX, and we think that as the Fed validates that slightly higher inflation target, that's going to continue to feed a bid into gold. All right. We're not big believers in the idea of the dollar, hegemony going away, which other people are arguing as a case for holding gold. Our view is that slightly higher inflation is going to lead to a kind of steady drip into gold in gold type assets. And then on the copper and oil side in particular, our focus has been on kind of like what Goldman Sachs has been saying, namely that the disconnect between continued solid end demand, physical demand, and financial asset or asset pricing is due to what Goldman, I think, called the biggest commodity destocking process in modern history. And so that's where, again, we see the destocking that happened in the goods sector in the US in particular over the last couple of quarters as kind of being similar to what's happening in the commodity space. So this destocking and restocking thesis of ours is something that we're looking to see play out in the second half of the year. And I'll give you just one example. Energy Intelligence, which is a group that we look at in terms of the energy space, came out last week and said that China physical demand for oil hit an all-time high in April of 16 million barrels a day, following on the March all-time high demand of 15 million barrels a day. And what did Brent and WTI do in a couple of days after that report came out? Went down about 7%. So it's like completely illogical, right? I mean, if China is growing demand at record levels for product, the price of the product shouldn't be going down, but that's what it did. And so, we're watching and paying attention carefully because, again, it's in our benchmark and we're overweight and we've been wrong. So yeah, that's an area of focus for us. And we're holding on to it because, as I say, we agree with the destocking thesis. We saw the same play out and in the good side in the U.S. So we are believers that we're going to see better manufacturing activity in the second half of the year in the U.S. and Europe. We're going to see better commodity demand, particularly copper and oil, in the second half of the year as it becomes increasingly clear that the global economy is in recovery, not going into recession. And so the way we look at the world, Asia is leading that global economic recovery with Japan and China. Europe is following along, notwithstanding weak manufacturing numbers. Again, 65, 70% services PMIs well above 50, and we expect the same in the U.S. And so when we come now, and now we're in June, which means people start to focus on the out year of 2024. And, 2024 is probably going to be a pretty good year. It's going to be a year where the Fed is done, where the ECB is done, where rate cuts are taking place, we believe, led by emerging market central banks. And we're pretty constructive on EM. For that reason, we expect the rate hiking cycle of the last year to be replaced by a rate cutting cycle in the EM, not so much in the US or in Europe, in the coming year. And that's going to be constructive for economic activity. That's going to be constructive for commodity demand. And that's going to be constructive for risk assets in those parts of the world.
So I'm thinking about that China thing because their PMI came in disappointing last week, the manufacturing PMI. And it seems like it's not growing as quickly as commodity bulls might have expected it to. And that's leading to disappointment. But I'm also thinking about Dr. Copper, right? Dr. Copper is now down over 15% on a year-over-year basis. And so they say it has predicting powers, doesn't it? I mean, wouldn't it be predicting a slowdown in the economy?
Yeah, no, absolutely right. I mean, different things work at different times, right? And you have to be sensitive to that. But look, I would say two things on Asia just to kind of wrap up that point. One is we talked about the birth of the new. and the new being that new inflation target the Fed's going to accept, new being that new industrial policy in the US that hasn't been seen for 70 years. The other news are in Asia, the end of yield curve control in Japan, which we think is going to be hugely significant for domestic investor asset allocation. For the last 10 or 15 years, it made no sense to own anything other than fixed income in Japan. And we think when the end of yield curve control comes, which we think is imminent, given that wage gains were at 30-year highs, inflation's running well above target in Japan, that's going to mean a bear market in bonds and a bull market in equities as the famed retail investor in Japan, Mrs. Watanabe, buys equities. And then in China, and this touches on your very good point, the difference in China is China's switching. The new in China is the switch from export and fixed asset-led growth to domestic demand-led growth. And we have a great chart in our monthly showing that household consumption equals only 35 or 38% of China GDP. In the US, it's 68%. In Europe, it's around 65%. So China's economy is still very unbalanced in that regard. And so one of the reasons why the economy is going to grow at 5%, 6%, somewhere in that level, without huge commodity demand is because it's not the same growth as, again, it was historically. China is trying to shift its growth pattern from fixed asset investing to domestic demand-led growth. And the question is, how do they manifest that, given that China, as I'm sure you know, has massive, massive savings, right? And those savings are there for old age and things like that because and even better in Europe, don't exist yet really in China. And so people are forced to save for their older years. And that's the type of stuff that we're looking to see in China as they manifest some of that, create some of that safety net, which frees up capital to consume, which drives up that household consumption as a percentage of GDP and allows China's not going to grow at 10% or 8%, right? China's growing at a lower level because it's already done all the easy stuff of taking people off the farms and putting them in the factories and things of that nature. So China growing at 4%, is still a massive, massive economy growing at 4%. It's going to be very, very good for the world. Where the demand for copper comes in is in things like electric vehicles, right? And the push on the climate side. That's where demand for that manifests itself. And so one of the things and we're believers in that thesis. And so one of the things that we worry about with oil is if the oil demand picture is shifting so rapidly because the EV expansion is growing so rapidly, right? The take-up of EV vehicles, as I'm sure you've seen, is a hockey stick. Is that impacting the demand for oil real time as opposed to, down the road? And that's, I haven't concluded anything about that. We haven't concluded anything about that, but, that is one of the concerns. And so, at this point, as I said, we own XLE, which is the big oil companies in the US, the ETF, and we're holding it. And we anticipate higher prices, particularly. But you can see the sentiment in the energy market is so bad that Saudis come out over the weekend and say they're going to take another 1 million barrels of oil off the market. And they have a pretty good history of doing what they say, unlike some of the other producers who say they'll agree to cuts and then don't cut. Saudis have a pretty good record, and it's much easier to track them than many producers. Market barely blinks. right? XLE was down today in the U.S. And so there's, sentiment is pretty lousy in the commodity space, and that's typically, when you get a bounce is when sentiment's really been depressed. And again, in 2 weeks, if the Fed comes out and says, you know what, we're doubling our growth estimate for U.S. GDP for 2023, that's probably when you're going to see a bid in some of the commodities.
Is this a long-term thing though? Like, what is the focus?
Sure. I'm sorry.
Oh, I'm sorry, you got cut off there. I was thinking, is this a long-term thing? Like, through what kind of a lens are you looking at this? Is this a 3 to 5 year thing that you're positioning yourself? Is it a 10-year thing when it comes down to commodities specifically?
We tend to look about 12 to 24 months ahead. We try to, or we tend to hold things for that kind of time frame.
Okay.
Not really an aggressive trader. We don't adjust our model portfolios. We only do it once a month as a matter of process. It's actually going to be this week. So we do the monthly, get everything kind of wrapped up in our head, and then we sit and update the model the next week, which is this week, because the monthly was on Friday. We update the model once a month, send it to clients, have a phone conversation with the client about the model. So there's one-on-one engagement with me for anyone who becomes a client of our model portfolio delivery service, and then we go from there. But typical holding periods, 1 to 2 years. But we think in big chunks of time. As I said, we've written that we think Europe could be the winner of the 2020s. We've written that climate is the single biggest global macro theme of this decade, because there's nothing else close in terms of having every country in the world spending money on it at the same time. And that's one reason why we're believers in the climate thematic. And that's one reason why we're believers in things like copper, because the demand for copper is, very clearly associated with the demand for electric vehicles. We have positions in carbon, we have positions in uranium for much of the same reasons. But we have a pretty healthy exposure to the climate side of things, both in our global multi-asset model as well as in our TPW20 thematic model.
Right. Because of the 3 C's that you mentioned, conflict, COVID, climate. What do you think is going to be the biggest winner, though, over that time frame, 12 to 24 months? Because you mentioned uranium. Uranium seems to have started moving. This is sort of where I'm overweight. This is where I've been overweight and suffering for a while now. So has uranium's time come? Is this the commodity that's going to outperform, or do you think something else is going to do better?
Yeah, I don't really know which will outperform. We've been invested in URNM, which is the miners for uranium, and it's been a painful place to be. So I looked today, and surprisingly, through Friday, URNM is up 6%.
Yeah, it was up 10% last week. It was kind of crazy, mostly on the back of Cameco, and Cameco is actually hitting new all-time highs for this cycle. Yeah. Not all-time highs, but for this cycle, it's hitting highs. So
we're believers that you need baseline power to offset the fluctuations in renewables, and that's best provided by nuclear. I think, again, as you know, probably better than me, there's a big tussle going on in Europe between Germany and France over how to qualify nuclear power. If that process becomes resolved in a positive way, I would imagine that would give nuclear a bounce. But copper at these levels seem very attractive. And gold miners, all the whole space is very attractive to us. The way we think about it is kind of what is the driver for each one. And so gold miner, the inflation, that's very specific. When we think about copper, we think about uranium, we think about carbon. That's much more, those are longer term plays that we anticipate holding. And how we deal with it, Antonio, is kind of more in the weighting, right? So if we're really bullish, we'll have a 5 to 6% weighting. If we're not so bullish, we'll have a 3 or 4% weighting. If we're not sure at all, if we're just beginning, we'll have a 2% weighting. So we really, we'll hold it and hold it for quite some time as long as the thesis is intact. And so for much of our commodity exposure, it is climate driven. And so I guess energy and oil would be different from that. But there, a lot of the work is focused on, return of capital and the amount of money that the oil majors are making. And they're returning, since they're not investing in, new fields, et cetera, that cash is going to come back to the shareholder. And so you have either buybacks or dividends, which are very, very compelling. And so for the XLE allocation, that's kind of what's driving that. But the 3 or 4 that are climate related, I can envision holding them for the next 3 to 5 years and imagine that if we're all right with our focus on how important climate is, single biggest global macro theme of the decade, then we should do fine with those allocations.
Okay. And it's mostly ETFs, like you don't pick specific companies?
No, we're 100% ETFs.
Okay. It's I know that I should probably start rounding up here, closing it off. And what amazes me is how well you're bringing these points and how well researched they are. And it amazes me not because you would do that. You have plenty of experience to do that, and you're an intelligent person. What amazes me is that when I talk to someone who's bearish, they do the same thing. Like they have very well researched points, good data. It all makes sense. And so this is probably a function of me just being, just obviously not at your level and kind of naive still, but I just believe what I hear. And like, I trust it. I believe you, what you told me, but then somebody else brings me a very well researched point as well. And so I'm bifurcated myself.
Yeah, no, I think, look, it's a tricky environment, right? So that makes sense. I think, you have to respect, both sides. And I do that. I like to read. I'm a reader. I'm a synthesizer of data. I'm a guy who kind of puts a picture together, right? I kind of think of myself in that framework, that really my greatest strength is as a synthesizer of lots of amounts of data, coupled with the ability, willingness to take risk by trying to look forward as opposed to trying to think about or talk about what happened, last week or last month. We're very focused forward at TBW Advisory, and that really comes from me. And so, I think it pays to pay attention to both sides. Again, at the end of the day, for the most part, we like to let the market tell us. And when the market is telling us something we don't like to hear, like with copper, then we want to really understand and dig into it. So when the market is telling us that this thesis is working, we want to really understand how much more does that thesis have to go. When the market is telling us this other thesis isn't working, then we want to understand, do we still have the same belief in, we test that thesis. And again, we allocate by weight as well as by position. So in our global multi-asset model, we have about 28, I try to keep it under 30 ETFs. In our TBW 20, we have 20, which makes it much simpler. Flat out no more than 20, no less than 20. And so in that way, it allows us to kind of move with the markets, right? And as I said, I've been investing my own capital for 20 years. I've been investing. The global multi-asset model has a over 10-year independently verified track record. So that particular instrument has 10-year history to it. And so, we're pretty comfortable about how we do it. Doesn't mean we're always right, of course. Over time, performance has been reasonably good. But obviously, there are both sides to every argument. And at a certain point in time, what makes this business challenging is that you have to pick a side and go with it, right? And if it was,
but I don't wanna.
Well, then you're probably gonna struggle to make a living in this business, at least managing capital, because managing capital requires you to, make decisions and have a performance that people will find appealing. Otherwise, then, that's not a business. And the way I say it is that, it's baseball season here in the U.S. The only person who's never struck out is a person who's never swung the bat. So if you're in this business, you're going to be wrong, right? You have to be totally comfortable with being wrong. And then the question is, don't let being wrong take you out. And you talked earlier, actually, this is maybe a good place to end, because you started us off talking about how people like to be, 100% allocated to stuff. And, I think that's a very, very risky way to go through life. As I said, we're global multi-asset for a reason. We've got three big buckets that we can play with, and we've got the whole world to deal with. And in a way, that's comforting for someone like me, because I could construct my portfolio and take the risk in a way that I want to. I would not be, I do not have the stomach, the mental or physical fortitude, to be 100% allocated in or out. That's a really tough way to make a living. But hey, if you can do it, more power to you.
True. I mean, if you can do it well, if you're very specialized and you know what you're doing, you could be better. But the problem is that most people think they could be better than most people, and that's just not possible. And so good point. Well, what's reasonably good, by the way? You said reasonably good performance. What is some performance that you can share with me that you've had, like 10-year or whatever you have?
Yeah, I don't have any of it on hand, but I can say that, we shoot for high single digit, kind of like an endowment type return. Because again, this is my own personal capital that underpins and underlies the global multi-asset model. So I think we're somewhere around, I might be able to get it for you real quickly here. Hold on. I don't want to take up too much of your time. Just got to find it. Not the longer one. All I have here is just the month, not the longer one. I think over 10 years, the global multi-asset model is up about 6%, give or take, a couple of tenths. And that's benchmarked to, again, the benchmark that I noted, which is up much less than that. And then also the hedge fund research index for macro, which is also up less than that. So 6% over the last 10 years or so is pretty much right in line with what we're shooting for. And is, as I said, better than either the macro index or the 60-40-10 or 60-30-10. It's 60-40-10, 110, 60-30-10, 50, sorry. Yeah, 50-40-10 benchmark. 50% ACWI, 40% Barclays Ag, and 10% Goldman Sachs Commodity Index.
Jay, it's been a real pleasure. Seems like we're going to have to do this again because there's lots to talk about. I'm going to leave the links to your stuff in the show notes of this video that people can click on, go and read it. Anything else that you came here hoping to talk about, but I'm failing to bring up?
No, I think we covered a lot of ground. I appreciate the opportunity to do so, Antonio, with you. You asked some great questions, and for your audience as well. I appreciate you putting up some of the links. So if people want to find me and kind of engage more directly with what we do at TPW Advisory, feel free to reach out. We're always in the market for new clients, and more than happy to come back. And, so we can test where we were, maybe at the end of the year, say we were here in June, here's what we thought about, talked about, here we are at the end of the year, what worked, what didn't, whatever works for you and your business, be happy to oblige.
Totally agree. Yeah. Thank you so much for investing your time with me, sir.
A pleasure.